Thank you very much. I have two questions. One to Mr. Mazzaferro. You spoke about the situation in the United States regarding the whole crypto universe and the role of the central bank. Now we have a whole new generation of shadow banks emerging. We know that the CBDC discussion has been catalyzed by the whole plans of Facebook around Libra. They have 1/3 of humankind as their customers, so it could have become a real threat in terms of too big to fail. Now we have other non-bank financial institutions working with data. Let's say Apple. Apple offers a lot of these buy now, pay later schemes, which may be less risky because usually Apple customers are a little bit more affluent. Maybe you have a lot of data on apps to observe their credit worthiness, but we can easily imagine some of these actors becoming bigger, and so far they are not so much connected with the traditional banking sector, but we can see, maybe we might see other trends in the future, so that they may merge in a way that they have less affluent customers and that they engage to a certain degree in credit business. So do you observe there any trends in Europe that should be alarming or not? So what's your view there? And the second question to Ms. Symon on the securitization, because I remember that there's now a new discussion around the Capital Markets Union enticing securitization to get off certain risks from banks' balance sheets to free up banks for credit extension. I have a much more conservative view on that. I think that as ECB surveys show, most of the lack of credit extension comes from the demand side. But what is your view on the recent discussions? Are there any trends you may observe at Finance Watch that you find alarming in that field? Thank you very much.
Thank you. Maybe we can start with you, Simon.
Yes, thank you. So on securitizations, and thank you for the question. This is indeed, I think it's quite remarkable how this topic captured so many discussions on for which role it plays currently and which role it can play. So in the first place, I'm not against securitizations. I think it's a valid tool, but definitely I think there is a misplaced kind of understanding of the role of securitizations. Again, where we stand now, and as you rightfully outlined, where the problems lie, demand versus supply, that it can really play in the Capital Markets Union. So what I think from my Finance Watch perspective, what we find most alarming is the fact that kind of the measures to promote securitizations are largely focused on the things like relaxing prudential requirements, which is just to remind again, is that the current prudential requirements on securitizations, they were designed after the crisis of 2008, right? So after the securitization frameworks and requirements turned out not to work, they were designed after that. And after those years, we never had a major event to test if the way the risks are being kind of modeled, and this is very complex both for banks and insurance. So these requirements have not been tested. So saying that they are too stringent, I think is a very big kind of jump to the conclusion. And we know again that securitizations also are by nature the exposures which play into the story of how the banking sector is then connected to the non-banking sector. So there are also other risks such as moral hazard and legal risks, which are very hard to model and put into all of those formulas. So again, this introduces additional layer of complexity, non-linearity, which is, to be carefully taken care of. Otherwise, I think we can definitely obviously discuss of should there be more securitizations or not. Obviously, it means that in the context of the CMU, there will be even more of bank lending. And we also have to be, I think, very kind of again, knowledgeable and reflective of like what are the actual impediments, why we don't have as many securitizations maybe in the EU as some actors would like to have. So things like fragmented markets, because we have 27 different regimes of how the securities laws work, how the insolvency regimes, which also are fundamental to securitization's work. So we will never be able to get a huge pool of homogeneous assets because of this. And this is why we currently have the situation where securitizations are mostly done in 5 big countries. Of course, because they are able to put those pools in together. And this is also a product which is largely being used by banks to get liquid collateral for the central bank lending, which I think is in its own right a good funding tool. Again, why not? But this is not a big financing tool for the economy. And again, kind of trying to force it via relaxing prudential rules is a path which only increases the risks which we put out there in the system. But on all of I think if we are able to start the topic about harmonizing those legal regimes, we can also have a topic of how we could get more securitizations, but we should also look at the right measures and not the wrong one. And maybe just one last interesting element, which is not so often being mentioned in the context of securitization, is the fact that there are also other products in the European Union, such as, for example, covered bonds, which are very popular in Germany and Austria, which don't have analogs elsewhere in the world. So we also look at our own markets and which instruments we already have to promote market-based financing. Thank you.
Thank you. Francesco Mazzaferro?
Yes, I wanted to thank about the question on Libra, because it's very important that we look really at the big picture. So the first consideration I would say is that in many respects, we are missing the scale of players which are able to bring the European voice. You know, it's not only, we have, I mean, with full respect, you're right when you say that the German funds are not systemic. They are very small. The problem of the German investment funds is they are too small. It's not that they are too big. So we need, so to speak, at a certain time to acquire scale, to be able exactly to impact on what is happening in the world. Second, Libra was indeed launched as an international endeavor. You may remember that Libra originally was indexed to the special drawing rights. They even didn't want to index to the dollar because the idea was to have a global payment system. Third, it's very probable that these giants will enter into the sector. And this is the reason why we need a system-wide approach. Because at a certain time, the day in which they will start to do even more than banking insurance, because they will have information on everything which we have done. So they will be able to provide me a life insurance which is based on the fact that they know exactly what they do day by night. Then it will be important to make sure that they are subject to something which is similar to Solvency II in some way. Otherwise, they will be able to basically wipe out the entire insurance industry. So these are new things which are happening. In my view, honestly, it's impossible to impede it because this is the direction in which the world is going. There is no measure which the European Systemic Report could take to impede people to operate with these players. We will clearly need to make sure that they are licensed and that they are subject to provisions which are activity-based and they are similar to the ones which are valid in Europe.